Hi everyone, and welcome to the first video in our series, Cryptocurrency for Beginners. I'm excited to kick things off today with our very first lesson, what is cryptocurrency. Before diving into the technical details of cryptocurrency, it's essential to understand why cryptocurrency emerged in the first place and what solutions it offers. So, I've divided today's lesson into three main parts to make things clear and engaging for you. First, let's explore the fascinating evolution of money. We'll take a journey through the different stages of money's development. Next, we'll see how cryptocurrency fits into this evolutionary timeline. Secondly, let's see what fiat money is and the differences between fiat money and cryptocurrency. So finally, let's use everything we've learned so far to define cryptocurrency. Alright, let's dive into our first part. Let's start with the evolution of money. In ancient times, people used a goods exchange system known as the barter system. For instance, if someone needed fruits, they had to trade something they owned, like an animal, to get those fruits. However, this system had many problems. Imagine having to trade a whole animal just to get a few fruits. There was no way to measure the value of goods accurately, leading to significant issues with comparison and fairness in transactions. Due to these challenges, people began seeking more practical ways to conduct transactions, and gold emerged as a solution. Right, the barter system had its limitations. This is where gold came into play. Gold provided a standardized value, making trade simpler and fairer. Its intrinsic value and durability made it an excellent medium of exchange. However, gold also had its downsides. Scamming was a significant issue, with counterfeit gold causing problems in transactions. Additionally, carrying large amounts of gold from one place to another was cumbersome and labor-intensive. Plus, gold is a limited resource which posed challenges as trade expanded. Due to these reasons, people transitioned to using metal coins. After gold, people moved on to using metal coins for transactions. Let's talk about why this change happened. Metal coins offered several advantages. They were easier to carry compared to gold, reducing the hassle of transporting wealth. Coins were also standardized in terms of weight and value, which made trade more straightforward and less prone to disputes. Additionally, coins were durable and could withstand everyday use. However, metal coins weren't without their drawbacks. Carrying large quantities of coins was still cumbersome and heavy. Additionally, the value of metal coins was often tied to the metal itself, which could fluctuate. Due to these reasons, people began to look for even more convenient ways to handle transactions, leading to the concept of paper money. After metal coins, the next significant advancement was the introduction of paper money. Let's explore why this shift happened. Paper money was lightweight and easy to carry, making transactions more convenient. Governments issued paper money, which helped standardize value and build trust in its use. However, paper money also had its downsides. It was prone to counterfeiting, which required constant vigilance and innovation in security features. Additionally, paper money could be easily damaged or destroyed. Due to these challenges, people began to adopt even more convenient and secure methods of handling money, leading to the concept of plastic cards. After paper money, the next significant advancement was the introduction of plastic cards. Let's explore why this shift happened. Plastic cards, such as credit and debit cards, brought numerous advantages. They were incredibly convenient, lightweight, and durable, making them easy to carry and use. Card payments became widely accepted, allowing people to make purchases almost anywhere in the world. Additionally, plastic cards offered enhanced security features and the convenience of electronic transactions. However, plastic cards also had their downsides. They could be lost or stolen, leading to potential financial fraud. Additionally, reliance on card networks meant that outages or technical issues could disrupt transactions. Because of these problems, people started using better solutions, leading to the idea of electronic money. After plastic cards, the next major advancement was the introduction of electronic money. Let's explore why this shift happened. Electronic money brought several significant advantages. It offered unparalleled convenience, allowing for instant transactions from anywhere in the world. With electronic money, QR code scanning payments became possible, making transactions quick and effortless. Digital wallets and online banking platforms provided enhanced security features and the ability to track and manage finances easily. However, electronic money also had its downsides. The dependence on internet connectivity and electronic devices meant that technical issues or network outages could disrupt transactions. Additionally, concerns about data privacy and cybersecurity posed challenges, as personal and financial information became more vulnerable to hacking and fraud. Due to these challenges, the need for a more secure, decentralized, and efficient financial system became evident, leading to the rise of cryptocurrency. Cryptocurrencies like Bitcoin and Ethereum offered innovative solutions to the limitations of electronic money, providing enhanced security through blockchain technology, reducing reliance on centralized systems, and enabling peer-to-peer transactions without intermediaries. Let's cover all these technical details of cryptocurrency later in this video series. So to wrap it up, we can say that cryptocurrency represents the latest and most advanced stage in the evolution of money. It builds on all the previous developments, from bartering with goods, to using gold and metal coins, to paper money, plastic cards, and electronic money. Cryptocurrency brings everything together with cutting-edge technology, offering a secure, decentralized, and efficient way to handle transactions in the modern world. Alright, let's move on to our second section: fiat money versus cryptocurrency. First, let's understand what fiat money is. So, let's break down what fiat money is. In simple terms, fiat money is the type of currency we use every day, like paper money. It's issued by governments and doesn't have intrinsic value. Its value comes from the trust and authority of the issuing government. Unlike physical commodities like gold, fiat money exists in physical form as paper notes and coins. It's a crucial part of our financial system, enabling us to conduct transactions and manage our finances. Now it's question time. Let's find out which of the following are fiat currencies and why. First, let's consider the US dollar. Is it a fiat money? Yes, it is fiat money. Let's see why. This US dollar is government issued. It's printed and regulated by the US Treasury and the Federal Reserve. It's also physical. We use paper bills and coins for everyday transactions. But what really makes the US dollar a fiat currency is its acceptance as valid money for dealing within the country. Its value isn't backed by any physical commodity like gold. Instead, it relies on the trust and authority of the US government. So, we can say the US dollar is an example of fiat money. Secondly, let's consider the gold. Is it a fiat money? No, gold is not a fiat money. Let's explore why gold is not considered fiat money. First, gold is not government issued. It is a natural resource and not created by any government authority. Gold is indeed physical. It exists as a tangible commodity. However, it doesn't function as a valid currency for everyday transactions within a country. Gold's value isn't universally accepted for daily dealings, and it isn't used as a standard medium of exchange like fiat money is. So, while gold has intrinsic value and can be used for trading or investment, it doesn't meet the criteria for fiat money because it lacks government issuance and everyday acceptability as currency. So, we can say gold is not an example of fiat money. So far, we have covered the evolution of money and fiat money. By now, you should have a clear understanding of these concepts. Next, we'll compare fiat money with cryptocurrency to give you a solid understanding of cryptocurrency as well. Now we know that we can say fiat money is the same as paper money. Cryptocurrency is the latest stage in the evolution of money, and it's more advanced than fiat money. Now, let's compare fiat money and cryptocurrency. So fiat money is physical. We use paper bills and coins in our daily transactions. You can hold it, carry it in your wallet, and use it directly in shops, markets, and other places. On the other hand, cryptocurrency is entirely digital. It exists only in electronic form. You store it in digital wallets and use it for online transactions or through digital platforms. There's nothing to physically hold or carry. Everything happens in the digital realm. So another crucial difference is their issuance. Fiat money is issued by governments. It's printed and regulated by central authorities, such as the US Treasury or the European Central Bank. This government backing gives fiat money its legitimacy and value. In contrast, cryptocurrency is not issued by any government. Instead, it operates on decentralized networks using blockchain technology. This means no single authority controls it. Instead, it's maintained by a network of computers and governed by its protocols and the consensus of its users. We will cover all these technical details later in this video series. Let's look at another key difference between fiat money and cryptocurrency. It is their control and structure. Fiat money is centralized. It's controlled by governments and central banks, which regulate the money supply, manage monetary policy, and oversee the financial system. This centralization means a single authority has significant influence over the currency. On the other hand, cryptocurrency is decentralized. It operates on a peer-to-peer network using blockchain technology, with no single entity having control. Decisions and transactions are verified by the network, making it more resistant to centralized manipulation and control. Next, let's explore another key difference. It is their supply. Fiat money has an unlimited supply. Governments and central banks can print more money as needed, which can lead to inflation if too much is produced. There's no fixed limit on how much fiat currency can be in circulation. In contrast, many cryptocurrencies have a limited supply. For example, Bitcoin has a maximum supply of 21 million coins. This built-in scarcity can help protect against inflation and maintain value over time. Now, let's look at another important factor. It is their geographical reach. Fiat money is restricted by borders. It's typically valid only within the country that issues it. For example, the US dollar is used primarily in the United States, and the euro is used in the Eurozone. Converting fiat money between countries often involves exchange rates and transaction fees. In contrast, cryptocurrency is borderless. It can be used and accessed globally without the need for currency exchange or cross-border restrictions. As long as you have an internet connection, you can send, receive, and use cryptocurrency anywhere in the world. Alright, now you have a clear idea of the differences between fiat and cryptocurrency. In today's world, cryptocurrency is becoming very popular. Let's find out why it's gaining so much attention. Let's talk about one big reason is decentralization. Cryptocurrency is decentralized, which means it's not controlled by any single authority or organization. Instead, it's managed by a network of computers all over the world. This decentralization makes it more secure because there's no single point that hackers can target. Another major factor is security. In the world of cryptocurrency, security is a top priority. Each transaction is protected by advanced encryption and recorded on the blockchain. Let's discuss blockchain technology in later videos. But this decentralized setup means there's no central point of failure, adding an extra layer of protection. Plus, with cutting-edge cryptographic techniques, your assets and personal data are shielded from unauthorized access. It's all about keeping your financial transactions safe and secure. Transparency is another crucial factor. Cryptocurrency shines when it comes to transparency. Every transaction is recorded on a public ledger known as the blockchain. This means that all transactions are visible to everyone on the network. You can trace the history of any transaction and verify its legitimacy. This openness helps to build trust and reduces the risk of fraud. With cryptocurrency, what you see is what you get, making financial dealings more transparent and accountable. Another big draw is low transaction fees. With cryptocurrency, transaction fees are often much lower compared to traditional banking or payment systems. Because cryptocurrencies operate on decentralized networks, there are no middlemen or banks taking a cut. This means you can transfer funds quickly and cheaply, whether it's across town or across the globe. Lower fees make cryptocurrency an attractive option for everyday transactions and international transfers alike. Cryptocurrency offers unprecedented global reach. Unlike traditional banking systems, which can be limited by geographical boundaries, cryptocurrencies can be accessed and used from anywhere in the world. As long as you have an internet connection, you can send, receive, and manage your crypto assets. This opens up financial opportunities to people in remote areas and those who might not have access to traditional banking services. It's truly a borderless financial system, making it easier to connect and transact globally. Another significant advantage is faster transactions. Cryptocurrency transactions are incredibly quick. Unlike traditional banking, where transfers can take days to process, cryptocurrencies can be sent and received almost instantly. Whether you're sending funds across the street or across the world, the transaction time is drastically reduced. This speed is due to the decentralized nature of cryptocurrencies, which eliminates the need for intermediaries and streamlines the process. Faster transactions mean you can get your money where it needs to go without the usual delays. So another compelling reason is inflation resistance. Cryptocurrency can offer a strong defense against inflation, unlike fiat currencies, which can lose value over time due to excessive printing or economic instability. Many cryptocurrencies have a capped supply. For example, Bitcoin has a maximum limit of 21 million coins, which helps maintain its value even as demand increases. This built-in scarcity makes cryptocurrencies less susceptible to inflation, providing a stable store of value in times of economic uncertainty. We will cover all the details about Bitcoin later in this video series. Another exciting aspect is investment opportunities. Cryptocurrency opens up a whole new world of investment possibilities. Unlike traditional assets, there are countless cryptocurrencies and blockchain projects offering diverse investment options. So cryptocurrency is at the forefront of technological innovation. It's not just about digital money, it's about revolutionizing the entire financial system. Alright, now that we have a clear idea about why this cryptocurrency is gaining more popularity, let's dive into something even more interesting. Cryptocurrency actually offers more features than traditional fiat currency. Exciting, right? So let's move on to our third section. Now, suppose someone asks you, can you give me a simple definition of cryptocurrency? What would you say? Let's break it down and understand a straightforward definition of cryptocurrency. Ready? Here we go. Here is a simple definition for cryptocurrency. First, let's read the definition, and then we'll break it down to understand it more clearly. Cryptocurrency is a type of digital or virtual currency that uses cryptography for security and operates on decentralized technology like blockchain. Alright, so that's the definition. Now, let's break it down in a way that's super easy to understand. Think of cryptocurrency as money, but it's all digital. You can't hold it in your hand like cash. Instead of being physical, it's virtual, living on the internet. Now, for security, it uses cryptography. Cryptography is like a secret code that keeps everything safe and secure. Imagine having a super strong password that nobody can crack. That's what cryptography does for cryptocurrency. And instead of being controlled by banks or governments, it runs on a technology called blockchain. Blockchain is like a public ledger, a record book that everyone can see but no one can change. It makes sure everything is transparent and fair. So, in simple terms, cryptocurrency is digital money that's super secure and operates on a transparent, decentralized system. Pretty cool, right? Now that you know the definition of cryptocurrency, you have a clear idea of what cryptocurrency is. In the later videos, we will dive into what blockchain technology is and how crypto actually works. Stay tuned, because there's so much more fascinating stuff to uncover. As a summary, here are the key points you should know. Cryptocurrency is the latest stage in the evolution of money. In our current world, we mostly use paper money, which is also called fiat money. However, cryptocurrency offers solutions to many of the drawbacks of fiat money. Plus, it comes with its own improved characteristics, as we've discussed in this video. So, stay tuned, because in the next videos you'll learn even more about cryptocurrency. There's a lot more exciting stuff to discover. Thank you for watching. Please give it a thumbs up and leave a comment below. Don't forget to subscribe to CryptoCookie.